Ladies and gentlemen, Archivist here. You have been reading this entire situation all wrong. While every financial news channel is currently talking about stock valuations, AI hype, and Federal Reserve policy, the world's largest asset manager just made a strategic move that practically nobody is paying attention to. BlackRock, controlling over $10 trillion in global assets, just positioned itself against long-term U.S. government debt, and they are not being subtle about it. In their December 2025 Global Outlook, buried beneath the catchy headlines about AI and tech stocks, BlackRock's Investment Institute delivered a verdict that should make every single American investor sit up. They went tactically underweight long-term U.S. Treasuries. For the first time in many years, they are actively betting against the very foundation of the American financial system. Now, you might think, as an archivist, what is the big deal? It is just one asset class. But you do not understand what U.S. Treasuries truly represent. They are the collateral for the entire global financial system. They are the risk-free asset that backs your pension, your insurance policy, and your bank's balance sheet. When BlackRock says they are underweight U.S. debt, they are saying we do not trust the full faith and credit of the United States government. Today, I am going to decode what BlackRock is really telling us. I am going to show you the 3 specific warning signals in their 2026 outlook that the mainstream media completely missed. I am going to explain why the U.S. national debt, which just hit $38.5 trillion, is not just a number, but a mathematical death trap. This isn't theory. This is forensic analysis of BlackRock's actual positions, their actual statements, and the actual math that proves America is running out of time. Let us start with what BlackRock actually published in their 2026 Global Investment Outlook, released December 2, 2025. They laid out 3 core themes. Micro is macro, leveraging up, and the diversification mirage. But it is what they said about U.S. government debt that should terrify you. Here is the direct quote from their report. We turn tactically underweight long-term U.S. Treasuries as we see high debt servicing costs and price-sensitive domestic buyers pushing investors to demand more compensation for the risk of holding long-term bonds. Let me translate that from Wall Street speak into English. U.S. government debt is becoming too risky to hold at current prices. The interest payments are exploding. Domestic buyers cannot absorb the supply, and we think yields are going much higher. This isn't speculation. This is BlackRock's official position. They are underweight. That means they own less than their benchmark allocation. They are deliberately reducing exposure to the asset that has been considered risk-free for 80 years. The term premium warning is the really terrifying part of why they are doing this. BlackRock specifically calls out the return of term premium. This is a technical term that most people gloss over, but it is absolutely critical. Term premium is the extra yield that investors demand to hold long-term bonds instead of just rolling over short-term bonds. For years, this premium was negative or near zero. Investors were happy to lock in low rates for 10, 20, or 30 years because they believed in U.S. stability. But BlackRock is now saying that term premium is rising, and according to their analysis, it is rising because of 2 forces. 1, high debt servicing costs. The U.S. now pays over $1 trillion per year just in interest on the national debt. That's more than the defense budget, and it is growing exponentially as old cheap debt gets refinanced at higher rates. 2, price-sensitive domestic buyers. Foreign buyers like China and Japan have been walking away from U.S. Treasuries for years. That left domestic buyers, U.S. banks, pension funds, insurance companies, to absorb the supply. But they are maxed out. They cannot buy more without destroying their balance sheets. So who is going to buy the next $9 trillion of debt that needs to be refinanced over the next 2 years? Nobody, unless yields go much higher. And this is why BlackRock went underweight. They are not selling because they hate America. They are selling because the math does not work anymore, but they are still overweight U.S. stocks. This contradiction is where it gets interesting. While BlackRock is dumping long-term treasuries, they are staying overweight U.S. equities. Specifically, they are bullish on large-cap tech stocks, driving the AI build-out. This seems contradictory, right? How can you be bearish on U.S. debt but bullish on U.S. stocks? The answer reveals their true thesis. They believe the U.S. economy can grow, but the U.S. government is broke. BlackRock sees AI-driven productivity gains creating real value in the private sector. Companies like Microsoft, NVIDIA, and Google are building genuine revenue-generating infrastructure. But they see the U.S. government as a zombie addicted to borrowing with no political will to cut spending or raise taxes. So they are making a bet. Private sector wins, public sector fails. They are buying the companies. They are selling the government. This is the shorting America thesis. Not shorting the American economy, but shorting the American state. Let us talk about the numbers that BlackRock's risk models are screaming about. Because once you see the math, you will understand why underweight is actually generous. You will understand why they should probably be running for the exits. As of January 6, 2026, the U.S. national debt stands at $38.85 trillion. That is not a projection. That is the official number from the Treasury Department. It was verified by the debt to the penny tracker. To put that in context, U.S. GDP is approximately $28 trillion. This puts the debt to GDP ratio over 135%. We now owe 1.35 for every $1 of value we produce. But here's the really ugly part. That debt is growing by roughly $2 trillion per year. Even in good years, even when the economy is growing, the structural deficit is baked in. According to recent data, the U.S. government now pays approximately $1.2 trillion per year in interest on the national debt. To give you some perspective, Medicare costs $900 billion, defense costs $850 billion, and interest payments are $1.2 trillion. Interest on the debt is now the second largest line item in the federal budget behind only Social Security. We are paying more to service our past mistakes than we are spending on the military, education, or infrastructure. But wait, it gets worse, much worse. Most of the current debt was issued during 2020 to 2022 when interest rates were near zero. Those bonds paid 1% or 2%, but they have maturity dates, and when they mature, they have to be refinanced at today's rates, which are 4% to 5%. The Congressional Budget Office projects that by 2028 annual interest costs will exceed $1.5 trillion. And if rates stay elevated, which BlackRock thinks they will, we could hit $2 trillion per year by 2030. Do the math. At $2 trillion in interest, the U.S. government would be spending 100% of all federal tax revenue just to pay the interest on past debt. Everything else, Social Security, Medicare, defense, schools, roads, would have to be borrowed. This is the textbook definition of a debt-death spiral, but the immediate crisis isn't 2030, it is right now. Over $7.6 trillion of U.S. Treasury debt is scheduled to mature in 2026 and 2027. That debt needs to be rolled over. The Treasury has to sell new bonds to pay off the old bonds. In normal times, this is routine. But look at who has been buying or not buying. Foreign buyers? China reduced holdings from 1.3T in 2021 to 775B in 2025. Japan, facing its own debt crisis, cannot keep buying. Oil exporters are buying less as they diversify into gold and other assets. Domestic buyers? Commercial banks' balance sheets are already stuffed with treasuries. Money market funds face regulatory limits on how much they can hold. The Fed is still running quantitative tightening, which means they are selling, not buying. So who buys the $7.6 trillion? The answer, according to BlackRock, is only if yields rise significantly. This is why they are underweight. They see a failed auction scenario where the Treasury tries to sell bonds, and there aren't enough buyers at current yields. Yields would have to spike to 6%, 7%, or maybe 8% to clear the market. And when that happens, every bank holding old treasuries at 2% yields gets crushed. The bonds lose 30% to 40% of their value. Regional banks, which BlackRock is also underweight on, become insolvent overnight. This is the 2008 financial crisis, but in government debt instead of mortgages. And here is the kicker. Even the Treasury Secretary knows it. Just a few days ago, on January 5, 2026, Janet Yellen gave a speech warning that the U.S. national debt is testing a red line economists have feared for decades. She specifically mentioned the risk of fiscal dominance, a scenario where government debt becomes so large that it overwhelms monetary policy. The Fed cannot control interest rates anymore because the debt burden is too heavy. Every rate hike makes the government's interest bill explode, forcing them to borrow more, which pushes rates even higher. It's a doom loop. And Yellen, who ran the Fed and understands these dynamics better than almost anyone, just admitted we are entering it. If the Treasury Secretary is sounding the alarm publicly, imagine what she's saying behind closed doors. So BlackRock is underweight U.S. Treasuries, but they manage $10 trillion. That capital has to go somewhere. Where's it going? And what does that tell us about what they really think is coming? Move number 1. Overweight U.S. equities, the private sector bet. Despite being bearish on U.S. government debt, BlackRock remains overweight on U.S. stocks, particularly large-cap technology companies. Their 2026 outlook specifically calls out continued strength in AI-related capital spending. They see strong earnings growth in the tech sector and 11% EPS growth for the other 493 S&P companies outside the Magnificent Seven. They believe Federal Reserve rate cuts will provide tailwinds. But this isn't a patriotic Buy America call. This is a buy the companies, not the government call. They are betting that Microsoft, Apple, Nvidia, and others will generate real profits from AI infrastructure while the US government drowns in debt. The thesis is that private sector productivity grows faster than public sector debt. The gap between corporate America and government America widens. BlackRock is choosing the winner. Move number 2, preference for Canadian and European bonds over US. Here is the really damning signal. While BlackRock is underweight long-term US Treasuries, they are expressing a preference for Canadian government bonds and select European bonds, particularly from the Eurozone. Think about that. Canada, a much smaller economy with its own fiscal challenges, is seen as a safer bet than the United States. Why? According to BlackRock's analysis, Canada has superior fiscal fundamentals. The Bank of Canada has more room to maneuver. Canadian government bonds are becoming less correlated with U.S. Treasuries, providing actual diversification. The Eurozone preference is even more interesting. For years, everyone joked that Europe was a mess with negative rates and slow growth. But now, BlackRock says, we prefer Euro area government bonds to the U.S. They are increasingly less correlated to fluctuations in U.S. Treasuries, and a sluggish economy gives the European Central Bank more room to cut rates in the near term. Translation: Europe's problems are manageable. America's problems are structural. When the world's largest asset manager prefers French debt to American debt, that is a 5-alarm fire. Move number 3, gold as a tactical diversifier. BlackRock's 2026 outlook also discusses gold, though carefully. They say, we like gold as a tactical diversifier with unique drivers of return, but we do not see the precious metal as a long-term portfolio hedge. This is classic Wall Street hedging language. They are not telling their institutional clients to load up on gold because that would create panic. But they are acknowledging that gold has unique drivers, meaning it moves independently of stocks and bonds. The timing is very interesting. Throughout 2025, central banks around the world bought gold at record rates. The price climbed nearly 30% year over year. And now BlackRock is telling clients, maybe you should own some as a tactical position. Reading between the lines, they see currency instability coming. They see fiat debt becoming less reliable, but they cannot say that explicitly without causing a client stampede. So they say tactical diversifier and hope the smart money gets the message. Move number 4, the alternative assets push. Finally, BlackRock's various funds have been aggressively moving capital into alternative assets, private credit, infrastructure, real estate, and commodity-linked investments. Their 2025 Fall Investment Directions report noted that client polling showed about half of their clients looking to diversify into alternatives like liquid alts, commodities, and digital assets. Why? Because traditional diversification is broken. Stocks and bonds used to move opposite each other. When stocks fell, bonds rose, protecting portfolios. But as BlackRock's own data shows, the 12-month rolling correlation between the S&P 500 and U.S. aggregate bond index has been positive for extended periods. Diversification is a mirage. When the crisis hits, everything crashes together. So, BlackRock is guiding clients toward assets that are tangible, real, and outside the traditional financial system. Private credit backed by actual businesses, infrastructure like pipelines and power plants, commodities that have intrinsic value. They are building collapse-proof portfolios for their institutional clients, pension funds, sovereign wealth funds, and endowments. These are the smart money players who cannot afford to be wrong. And if BlackRock is building them collapse-proof portfolios, what does that tell you about what BlackRock thinks is coming? We have established what BlackRock is doing. We have shown why the math is broken. Now we need to answer the critical question. Is this a 2027 problem, a 2030 problem, or is the fuse already lit? Based on BlackRock's positioning and the debt dynamics we have discussed, I see 3 specific trigger events that could cascade into a full-blown U.S. debt crisis in 2026. Trigger number 1, debt ceiling crisis, January to March 2026. The U.S. government hit its debt ceiling limit again. Treasury Secretary Janet Yellen is currently using extraordinary measures to keep paying the bills, but those measures run out around March 2026. Congress will have to raise or suspend the debt ceiling, but we have a deeply divided political environment. The House has a razor-thin majority. The Senate is split, and there's a presidential election in November 2026. so every vote is radioactive. If Congress fails to raise the ceiling, even for a few days, the U.S. could miss a payment on its debt. This would be catastrophic. Credit ratings agencies would downgrade U.S. debt. Money market funds would be forced to sell. Margin calls would cascade through the system. BlackRock's positioning suggests they give this a non-trivial probability. They are not pricing it as the base case, but they are hedged for it. Trigger number 2, failed Treasury auction in Q2 2026. This is the one that keeps Treasury officials up at night. Sometime in Q2 2026, the Treasury will need to auction hundreds of billions in new bonds to refinance maturing debt. If foreign buyers stay away, if domestic buyers are tapped out, and if yields are not high enough to attract capital, the auction fails. Not all the bonds get sold. The Treasury has to either raise yields dramatically, spiking borrowing costs, or have the Fed step in as buyer of last resort, which ends quantitative tightening and reignites inflation fears. Either outcome is catastrophic for financial markets. BlackRock's underweight positioning is essentially a bet that at least one auction will struggle in 2026. Trigger number 3, Moody's downgrade follow-through. In December 2025, Moody's downgraded the U.S. credit rating outlook. They did not cut the actual rating yet, but they put the U.S. on negative watch. If the fiscal situation deteriorates further, if deficits widen beyond expectations, or if Congress passes more unfunded spending, Moody's could pull the trigger and actually downgrade U.S. sovereign debt from AAA. This would be a historic moment. The U.S. has held AAA status from at least one major agency continuously since the rating system was created. A downgrade would force institutional investors with AAA-only mandates to sell, increase borrowing costs for the government, and shake global confidence in the dollar. BlackRock's team knows this is coming. The only question is the timing. Ladies and gentlemen, we have walked through the evidence. BlackRock, the most sophisticated asset manager on the planet, is positioning away from long-term U.S. government debt while the national debt accelerates toward $40 trillion. This isn't conspiracy theory. This is their public filing, their official outlook, and their stated positions. The question is, what do you do about it? Protocol number 1, do not fight the Fed or BlackRock. The first rule of investing is simple. Do not fight the smart money. When BlackRock goes underweight U.S. Treasuries, they are seeing something in their risk models that justifies the move. If you own long-term Treasury bonds or bond funds, like TLT or EDV, in your portfolio, you need to seriously evaluate that exposure. These are going to get crushed if yields rise from 4.5% to 6% or 7%. A simple rule is duration pain. The longer the maturity, the more the bond falls when yields rise. A 30-year Treasury can lose up to 40% of its value if yields rise by just 2 percentage points. Consider rotating into shorter duration debt, perhaps 1 to 5 years, or floating rate notes that adjust with interest rates. You will sacrifice some yield, but you will preserve capital. Protocol number 2. Follow BlackRock into equities selectively. BlackRock is overweight U.S. stocks, but not all stocks. They are specifically focused on large cap tech with strong balance sheets. Companies driving AI infrastructure build-out and firms with pricing power and strong margins are the priority. These companies can survive, even thrive, in a high-rate, high-debt environment because they generate real earnings and real cash flow. Avoid small-cap stocks heavily dependent on economic growth and cheap credit. Avoid high-leverage companies that need to refinance debt at higher rates. Anything dependent on government spending will get squeezed. Protocol number 3, the hard assets hedge. BlackRock called gold a tactical diversifier. Take the hint. A 5% to 10% allocation to physical gold, not paper GLD, but actual coins or bars in your possession, provides insurance against currency instability. Also consider silver, which is still historically undervalued relative to gold. Look into commodity-focused funds that own real assets or international bonds from fiscally sound nations if you are sophisticated enough. The goal isn't to get rich on these assets. The goal is to not go broke when the debt crisis hits. Protocol number 4. Build liquidity and flexibility. In times of crisis, cash is king. Not because dollars are valuable, but because everything else gets repriced lower and you can buy at fire sale prices. BlackRock is keeping limited directional equity exposures and maintaining flexibility to pivot quickly. You should do the same. Do not be 100% invested. Keep 10% to 20% in money market funds or short-term treasuries. Be ready to buy when others are forced to sell. The great wealth transfers happen when the leveraged and rigid get liquidated and the liquid and flexible step in to buy. Protocol number 5. Understand this is a long game. Here is the important caveat. BlackRock is tactically underweight treasuries. That means 6 to 12 months, not forever. They are not saying the US government will collapse next week or that the dollar will go to zero. What they are saying is in the next year, US government bonds are a bad risk reward. The downside is bigger than the upside. Could they be wrong? Of course. Maybe Congress passes a massive deficit reduction package. Maybe AI productivity gains are so huge that tax revenues surge. Maybe foreign buyers come flooding back. But BlackRock is not paid to bet on miracles. They are paid to protect capital. And right now, protecting capital means underweighting US government debt. Let us bring this home. BlackRock did not just short America. They are making a far more nuanced and more dangerous bet. They are saying the US economy can grow, hence overweight equities, but the US government is structurally broke, hence underweight treasuries. And this divergence is going to create chaos in fixed income markets over the next 6 to 12 months. The $38.5 trillion national debt isn't just a number. It's a mathematical trap. With over $1.2 trillion in annual interest payments and $7+ trillion in refinancing needs coming due, the US government is one failed auction away from crisis, and the world's largest asset manager, the firm that manages more money than the GDP of most countries, just positioned away from the blast radius. This isn't doom and gloom. This is forensic analysis. BlackRock filed their 2026 global outlook publicly. They stated their underweight position explicitly. They explained their reasoning: high debt service costs, lack of buyers, and rising term premium. The mainstream media isn't covering this because it doesn't make for good television. There is no dramatic crash yet. There is no specific villain to point at. There is just slow-motion math, compounding debt, rising interest, shrinking buyers, all grinding toward an inevitable conclusion. But you are not the mainstream media consumer. You are here because you want to see the signal in the noise. And the signal is clear. BlackRock is building lifeboats while others are rearranging deck chairs. The question is, are you going to be on the boat or in the water when the tide goes out? This is Archivist. The protocol is active. Class dismissed.